Should you invest in direct mutual funds? Hey guys, today we're going to know if you should invest in direct mutual funds. Let's get right into it. Mutual funds were created to make investing easier for investors who don't want to deal with the details. Investing in a mutual fund entails sending money to the fund and then receiving units in the fund. When you invest in a mutual fund, you become the owner of dozens of companies that the fund has purchased. It makes no difference whether you invest $6 or $6,000, you still own a piece of all the stocks the fund owns. Professional fund managers manage mutual funds, which pool money from multiple investors to buy financial securities such as stocks, bonds, money market instruments, and other securities. Mutual funds are typically divided into two types, regular and direct mutual funds. Both mutual fund plans offer distinct advantages, and investors should be aware of these two options in order to make an informed investment decision. First, what are direct mutual funds, and how is it different from regular mutual funds? First, direct mutual funds are mutual funds that are offered directly by the AMC or fund house. In other words, no third-party agents, brokers, or distributors are involved. There are no commissions or brokerage fees because there are no third-party agents involved. As a result, a direct mutual fund's expense ratio is lower. As a result of the lower expense ratio, the return is higher. A mutual fund's direct plan is easily identified because the word direct is prefixed in the fund's name. These mutual funds can be purchased both online and offline. Meanwhile, regular plans are mutual fund plans purchased through an intermediary. Brokers, advisors, and distributors are examples of intermediaries. For selling their mutual funds, the intermediaries charge the fund house a fee. This fee is typically recovered by AMCs through expense ratio. Regular mutual funds have a slightly higher expense ratio than direct mutual funds. As a result, the returns on direct plans are slightly higher. A regular plan is ideal for investors who do not have the market knowledge or the time to monitor their portfolio. As a result, a regular plan is far more convenient for investors who are unfamiliar with the market. So, what is the distinction between regular and direct mutual funds? To begin, it is important to note that in a regular mutual fund, sales commission is paid to the broker who sells the mutual fund for the asset management company, or AMC, and the percentage of commission can range from 1% to 1.25% per year. AMCs are not charged a sales commission in a direct mutual fund, making it more convenient for investors. Furthermore, because there are no intermediary charges in a direct mutual fund, it provides a higher return than a regular fund. Investing in direct mutual funds can thus help you generate a higher return on your investment. Choosing the best mutual fund is not as simple as it appears. Only after you understand your risk tolerance, investment goals, and time horizon can you select a mutual fund that meets your needs and investment objectives. Direct mutual funds may be preferable for those who understand the fundamentals of the stock market and have previous experience investing in the stock market. A regular plan, on the other hand, will do the work for investors who do not have much time to research the market. A regular mutual fund employs professional stock pickers to improve the performance of your portfolio. Direct mutual funds, on the other hand, do not provide such services to investors, forcing them to keep track of their portfolio on a regular basis. Finally, the net asset value of a regular fund is lower than that of a direct fund, because a regular fund charges a high expense ratio to its investors, whereas a direct mutual fund does not charge any management fee or commission to its investors. As a result, direct mutual funds have lower expense ratios. So, which is better, direct mutual funds or regular mutual funds? The expert fund manager manages both direct and regular mutual funds, which invest in the same financial securities. Direct mutual funds are less expensive than regular funds because there are no intermediaries and no commissions to pay to third parties. Direct plans may be preferable for those who want to earn a higher long-term return because they provide a better return than regular plans. If you are an informed investor with stock market experience, choosing a direct mutual fund may appear to be a good deal. On the other hand, if you are new to the stock market and require expert advice from professionals to select the best mutual fund for you, a regular mutual fund will suffice. A financial advisor can save you a lot of time by helping you plan your finances, understand your risk tolerance, and choose the right fund for your needs. To summarize, as an investor, you should be aware of the benefits and drawbacks of investing in both regular and direct mutual funds. If you are new to the stock market, you can begin your investment journey with a regular mutual fund and then transition to a direct fund as you gain experience and knowledge. Do your homework before making any investment decisions and use your money wisely. But here's an investing tip. There is no guarantee that a stock will rise after a significant decline. Know that it is critical to be realistic about what is possible and what is impossible in the stock market. So if you notice that a stock in your portfolio is underperforming, admit your error and sell it right away to avoid further losses. That's all for today, and we'll be sure to catch you all in the next one.